March Fed meeting. And I think that's really what's going to be on the minds of markets all day today, albeit it's been a bit of a roller coaster week. We did get the bounce that we were expecting towards the end of last week. Whether or not that is over, I don't know. A lot will depend on the Fed tonight. You can see from this chart that we went decisively through the 200-day on SPY and got down to about 5,500, just below the strike of that big JP Morgan put option that's rolling off on Friday, and we bounced. And Friday was a green day and Monday was a green day. So that's the first two green bars we've had in a row since late February. So that was somewhat expected. Let me let the cat out so she doesn't annoy us. One out, one in. Get some sort of cat filter on my soundboard so you don't hear the cats meowing. Or just kick them out in the morning. Maybe that's the answer. Yeah, so a little bit of positivity to end last week. To start this week, I guess we did not have any more tariff news over the weekend, and the markets were looking ahead to the Fed today. And we also had a call between Trump and Putin over Ukraine, where I think there was some hope there may be a ceasefire announced, but in the end, the most that came out of it was somewhat an agreement not to bomb what's left of Ukrainian energy infrastructure. So Putin giving Trump the absolute minimum that he needed out of that call, and it remains to be seen where we go from there. In general, yesterday was a red day across most sectors. The standouts being healthcare and financials that were somewhat green. I suppose real estate, utilities, basic materials, but pretty much everything above that was red. Tech continues to sell off. That leaves the year to date. The week looking like this, so that's that 1 week view does reflect the bounce that we've seen in some of these tech names. Not all of them. These guys are still down on the week. They reversed the losses, but they're still down. And financials bounced back strongly. India, a good performer on the week, but down yesterday. Case of, as is often the case with Nvidia, traveling is better than arriving. The GTC or whatever they call it kicked off yesterday. A lot of hope and expectation for Yang Sen Hang's keynote speech, and as usual, he announced a lot of new cool stuff, and the stock went down. So Nvidia down yesterday 3.4%, up slightly pre-market, but this time of the morning, the pre-market's very illiquid and isn't really going to tell us very much. Let's say I think a lot of today is really just waiting for tonight. Do remember, because of the clocks change in the US, changing earlier than here, the Fed is earlier today than normal. It's will kick off at 7 p.m. European time, 6 UK, with the release of the interest rate decision and the statement, and also the economic projections, and we'll get to that a little bit later. And then there'll be the press conference at 7:30. So it does come just towards the end of the trading day, and just after you finish your tea, if you're in the UK. So watch out for that. This is just a broader look back at what the S&P's done this year. As I said, it's bounced off the lows, but it doesn't look particularly convincing, does it? We bounced and we failed to break the 200. We're pretty much flat this morning. Yesterday was a down day, and that 20-day moving average is rapidly approaching the 200, and if it crosses over, in some sense, that's the end of the current uptrend, depending on how you cut it. What's happening at the moment looks pretty similar to my eyes to what was happening in 2022. where we got sideways price action in end of 2021. We got a new all-time high. The market traded down quite quickly. It broke the 200. It actually then, so this, you ignore that. This looks very similar to where we are at the moment. And we had a series of what we call bear market rallies all the way through before we finally put in a low at around 3,600 in October of that year. So should tariff uncertainty, because that's really economic trade policy uncertainty is really what's causing the issues here to some extent. If that continues and if it does start to seep into growth, perhaps the Fed don't cut as quickly as the market would like them to, then we may be going into this sort of a slow roller coaster of a slow, fast downtrend, which is quite tradable. You can see that, just watch it, just checking the RSIs here. Typically give you a good signal to buy into these rallies. The market never got overbought, but once the RSI sort of was above 50, it was typically a good time to sell the rallies. So as I've been saying for a while, I think this is still a sell the rallies market. It remains to be seen just how much pain we have to take before we get the good stuff from the current administration. I suspect we will have to take a little bit more. That's just a picture of some of the tech stocks, all looking a bit unloved, floundering a little bit. But there are other things out there other than US tech that are not doing quite so badly, and that are actually showing quite a nice uptrend. This is the DAX. It's not as overbought as it was. It's still not technically cheap, but with I think Germany is going to approve its new defense budget today or tomorrow. This should continue to trade higher. This is a stock I put on yesterday. It's just about to have a 20 over 200 crossover. I think we could confidently call that a breakout. And this is RWE. They're a German power generation company. I think they control about 60% of the power generation market in Germany. They've recently done some deals with Meta for renewables and clean energy in the US for data centers. So they're very well placed for the reindustrialization of Europe, should it continue. And again, as you can see, they've been doing particularly well since that fiscal loosening was announced in Europe. And in general, I think that is a big theme at the moment. You have Europe doing fiscal, China doing fiscal. China did announce another, well, they didn't announce the actual stimulus measures, but they announced an intention to stimulate. It's often the way with the Chinese. They don't give us all of the information at one time. But China and Europe are both spending money, while the US is looking to pinch pennies and detox. And that means the dollar falls. Money is flowing out of the US into these other regions, and I think that will just continue. Some of the relative outperformance probably is a little bit stretched here, but I still think, as I said at the end of last year, at the start of this year, it's a year to look maybe a little bit further afield than the Mag 7 or the Bag 7, as I've heard them being referred to recently. So that's RWE. I quite like that. It's got a liquid options market. If you have interactive brokers, you can trade options on this. As long as you have Eurex permission switched on, you cannot access it through thinkorswim or tastytrade because it's listed. It's a stock that's listed in Germany on the Eurex exchange. You can trade ETFs on the DAX that are listed in the US, and they do have options on them, albeit maybe not the most liquid in the world. But of course, you can also trade the DAX directly on interactive brokers, or as I said, trade a proxy for the DAX through a stock. We'll have a little bit of a deeper dive, I think, tomorrow on some candidates for these type of trades. One thing that you can trade on your US platforms on thinkorswim is EWZ Um, that is the ETF that tracks the Brazilian stock market. Brazil's been a bit of a dog um, for the last year or so, as you can see from this chart. When S&P was flying, its market was falling. It reached a low around about the start of this year, but since then, again, like many things non-US, it's been bouncing quite strongly. Um, Brazil's going to have elections next year, and it may be the case that the current incumbent Bolsonaro gets kicked out, and that would be very stock market positive. But again, watching EWZ here um, for potentially breaking out through its 200s and possibly going into an uptrend. Again, very strong performance over the last few days, but I think it's a market that again can continue to rally. Certainly looks cheap on a valuations basis compared to some of the other markets, and I say it's a bit unloved, and I think an interesting place to look at for opportunities. Again, that could be traded with options, or you can simply, well, you can't buy the ETF if you're a European resident because it's one of these non-UCITS, but you can buy UCITS equivalents, or said you can just trade options on it. So some options implementations might just be a simple leap option. Buying 24 calls, something like that, buying just below the lows here, high delta calls. If you want a bit more leverage, one could look at sort of something in the region of 29 and 30, or even a call spread up here. Again, Brazil, I think, is a nice way to diversify and say it's while it's been outperforming the US this year, over the last, what's that, 6-7 years, it's just massively underperformed. As you can see, this is the ratio between EWZ and SPX, and absent a little bit of a pop back in 2018-19 when they had a bit more regime change, it's just been going down. So if that finally is turning up, and we do get a decisive break of this is a weekly chart, I think, so the 200 week, it may just turn out to be one of these flashes in the pans, but at least, the rally has room to go, I think, even if ultimately it does turn back down again. So that's Brazil for EWZ. One other thing I thought it's interesting, it came up across recently, and it's getting a little bit of love on the sort of various semi-professional research sites, shall we say, is CCIR. So this is a SPAC, a special access company. So we could do a whole hour on SPACs, but I guess you probably heard about them. They're just vehicles to accumulate cash and then redeploy that cash into some sort of merger or buying some company. What these guys have done is they're going to list the largest mobile operator in Ukraine on the stock market on the Nasdaq in Q3. At least that's the idea if the merger goes as planned. That's a company that's debt free. Is valued about 4 times EBITDA, and has about a 15% free cash flow yield. So it's a pretty decent, pretty solid company. It's also in Ukraine, and it serves most of Ukraine. We'll be rolling out 4G to most of Ukraine later this year if everything goes to plan. So if we were to get a ceasefire in Ukraine, and this company will list as Kiev, KYIV, when it lists, if it lists. But ahead of that, the only way really to get access to the purest play on Ukraine at the moment is this SPAC. The way they're structured is, in theory, you can redeem your shares at $10. That's why they sort of flatline around $10.5. So if the merger does not go through, if they don't find a target within 2 years, or if you just feel like it, you could activate your option to sell this at $10. So in a sense, it's got a floor at 10. Certainly instances where SPACs have traded below their floor momentarily, but for all intents and purposes, this is limited downside, unlimited upside, albeit it's not going to 2 or 3 or 4 times before the merger. But as you can see, it's traded up with the Ukraine ceasefire news. No options on this, at least not easily accessible. There are some warrants. But yeah, just an interesting one. About 20% downside from here, and I think reasonable upside should we get that pop in Ukraine. And it is up pre-market. It's actually, looking at the pre-market, it's up 5.3% pre-market, so maybe it's not quite so attractive anymore for you guys. I bought some yesterday, but I think that's an interesting one, and maybe something we don't often talk about is SPACs. But yeah, CCIR. Keep an eye on that. More broadly, CTA positioning is now short US equities. That will turn into a tailwind if we do get a proper bounce from here. History, at least, if history is any guide, it shows that we often do get a market bounce post, or we did the last time round post all the tariff news, but I do think this time things are a little bit different. I think nowadays Trump has the ability. I don't think it was ever the case that he said things and then didn't follow through with them because he didn't have the conviction to do them. I think it was more that he wanted to do them, but he was talked out of it or was not allowed to do it. Now he's surrounded himself with effectively yes men. And so everything he says, expect he will do it. So I very much expect tariffs to remain in some form, and it's whether or not that kicks off a trade war that's important for markets here. All of that uncertainty has led to earnings revisions. So earnings have been revised lower fairly substantially. That maybe makes this upcoming earnings period a little bit easier. And remember, we do have earnings coming up and kicking off in a few weeks with the financials. So again, that could be a source of potential bounce in markets. This is just showing you ETF flows out of the US into Europe. What the institutions have been, the hedge funds have been doing recently. Institutions, we noted more recently they were sitting on their hands, but last week they started to sell and they sold about 13 billion. So quite a big shift in positioning in institutions. So we can see that's the March fund manager survey from Bank of America, just showing us that this is the biggest ever drop in US equity allocations. So US equity allocations cut by 40% and Europe increased by 30%, and EM as well. So remember Brazil, EM, that's where money is going. So out of tech equities, predominantly out of the US and into Europe, into UK and into EM. And that's really quite a substantial chart. Of course, this is just an answer to a survey. It's asking where are you positioned. It's not based on any hard data. People can lie on surveys or maybe give the answer they wish they had done. So this is not necessarily fact, I would say, but we can back it up by looking at the actual flows where we see institutions have been selling. Also, the fact that the euro has continued to go up suggests some repatriation of assets going on as well. So all that means that US equity valuations are no longer at nosebleed levels. The Mag 7 is now back to, as we talked about before, it's back to its valuation lows over the last 7 years, and even the S&P X, the Mag 7, is back down again. So recent sell-off has certainly made stocks more attractive from a valuations perspective. It's also led to gold continuing to go up, and part of the reason gold has continued to go up is demand, and Goldman's here forecasting that demand is only going to be higher from here, and that should keep gold moving higher. A lot of people pointing to it saying, how can it keep going higher? It's at all-time highs already. It's above $3,000. Well, I found this chart. If you price gold in real terms, so you inflation adjust it, it's actually only back to where it was in the 80s. So we're only just breaking out in real terms. And also, if you look at gold mining as a ratio, the gold miners as a ratio to global stocks, they've been on the lows for years. And again, plenty of room for them to break out. So that GDX trade that we hopefully had on at the start of the year that did quite well. Maybe it's time to reload that one. Something else that's interesting and looks attractive here, I think, is the US regional banks, particularly if the central bank tonight, the Fed, steps back from QT, as many think it will do. That will release more liquidity into the system, and that's good for financials. And this is already um, sold off substantially. So I was bullish on financials start of the year, still bullish. I think KBE is interesting here. It's just showing you breath. Onto the Fed in the last 5 minutes. This is what I'm expecting tonight from the Fed. No rate change. They're not going to cut interest rates. Don't worry about that. Rates will remain where they are. We don't expect there to be any dissenters on that either. Probably some changes in the statement that are likely going to reflect a worsening outlook for growth and inflation. So we think they'll probably mention moderate growth. I don't think they'll mention tariffs or trade policy. They've been very consistent about not being drawn on that. And continue to give us confidence the labor market is solid and inflation is a little bit high, and they'll use this sort of roughly in balance language on risks. What we also get today, which will be interesting at the same time as the policy decision, is the summary of economic projections. So last time we got that was December. If you remember back in December, markets acted very aggressively to this and to Powell because it revised down growth and it revised up inflation, and it also revised down participants' expectations of where rates will drop to. So we're expecting more of the same tonight. So not just me, the streets economists. So I think you will probably see growth revised down, inflation revised up, maybe employment revised slightly up. But no change in the dot plots, so no change in the projection for interest rates this year, but possibly slight uptick in the longer run median dot. None of that is positive. The challenge is just whether or not the market already accepts that this is what's going to happen, or these numbers change more aggressively higher. I think it's pretty clear this is what the Fed are thinking, and this is the direction they'll go in. But the challenge will just be how the market takes that news. That's always the difficult thing with Fed meetings. But just watch out for not necessarily the rate decision, but the economic projections and the commentary around that. That's probably going to be more interesting than what Powell is going to say, because I think Powell is going to, as he normally does very well, just play it straight down the middle. He won't make strong statements on trade, immigration, fiscal policy. And I think he'll just tell us more of the same that he did at his last press conference, which at the time was positive for markets. So we wait and see. But it's worth noting that the market is pricing more in terms of interest rate cuts this year than Fed participants are. And yeah, this is the format of that summary of economic projections that we will get updated. So watch out for headlines on that. Yeah, and in general, what the market needs here is this uncertainty level to drop again. It's just far too high, whether it's trade or whether it's headline policy that needs to fall really, I think, for us to put in a tradable low here, and